So you might be wondering how to get approved for an FHA loan, and you are in the right place. FHA loans are one of the best options for first-time home buyers or those with lower credit scores. So let's jump into exactly what you need to know to qualify for an FHA loan. Hey guys, my name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgages and home loans, subscribe to our channel. We post new content each week. And if you're ready to get qualified for a home loan or you're looking to get connected to a great real estate agent, our contact information is in the description below. So before we get any further into this, let's quickly just define what an FHA loan is. It's a government-backed mortgage which is designed to make home ownership more accessible to more buyers. These loans are backed by the Federal Housing Administration, which means lenders can offer more flexible requirements, lower down payments, and typically lower interest rates. So long story short, FHA loans can literally open the door to millions of homeowners. All right, so we're talking about qualifying for an FHA loan, so let's jump into the requirements for an FHA loan, and it really simply starts with your ability to repay. So that's a mortgage term that we use pretty frequently. The acronym is ATR, again, ability to repay. And how do we determine your ability to repay? Well, we do that by reviewing your income, your assets, and your credit history. And then we're gonna combine all of that into a loan application, which will then help us determine your debt-to-income ratio. You're like, what's that? Well, it's a very specific percentage that really ultimately determines what your buying power is. All right, so rather than just kind of a boring conversation through the FHA guidelines as my hands are all over the place, I thought it would be more fun to actually tell Ryan's story throughout. So hopefully that makes sense. So first and foremost, what we want to look at, like I said, is income and employment. So income is really simply how you get paid, and underwriters are always looking for both stable and continuous income. So FHA guidelines require at least 2 years of stable employment history, and that's assuming that you're employed or self-employed. So if you're employed, you don't have to have worked the exact same job for the past 2 years, but you do have to have 2 years or at least 2 years of work history. Now, it does help if it's in the same industry, and it certainly helps if you've not had frequent job changes. So honestly, I can recall one borrower, and it's only happened a few times in my mortgage career where we've not been able to get somebody through underwriting. I can probably count that on one hand. So this specific borrower actually changed jobs about 6 times in the previous year, and we tried our darndest to get their file through underwriting, but it was just too much job transition for the underwriter to feel that his employment and his income was both stable and continuous. So remember those keywords, stable and continuous. So you may have heard me say 2 years over and over and over. That is a key period of time in the mortgage world, whether that we're talking FHA or conventional. Honestly, 2 years is kind of that magic mark for stable and continuous. So again, we're going to hit on 2 years throughout this film and through others, but just keep that in mind. All right, so good news, back to Ryan's story. He had a 2+ year history of working for a local health insurance company where he earned an hourly wage as a full-time employee. So his employment and income was stable and continuous, and it checked all the boxes. All right, so what if you're in a situation where you are not employed? So unlike Ryan, maybe your income comes from other sources like Social Security or retirement or pension or investments or something else altogether. There's really exhaustive amount of places you can have income. And it's the lender's job to confirm that that source of income has been in place for a sufficient period of time. And that's usually between 1 and 2 years, and that it will continue for at least 3 years in the future. That's called continuous, right? So we're looking for history of 1 to 2 years and that it will continue for at least 3 years in the future. So income is most commonly verified through pay stubs and W-2s, and that's if you're an employee. And Ryan, if we go back to his story, provided us with his most recent 30 days of pay stubs, as well as his W-2s from the past 2 years. Again, here we are 2 years again, right? All right, so now that we've covered income, let's jump into the second thing we mentioned, which is assets. And you're gonna need assets to cover your down payment and your closing costs. Hopefully assets is not a weird term to you. It's certainly a mortgage term, but it's really just your savings, right? And savings specifically in a bank account. All right, so FHA requires a minimum down payment of 3.5%, and Ryan was hoping to buy a house for about $250,000. So at the recording of this film, that might be more difficult, but we're telling a story from several years ago, so it's still relevant, I promise. So this means that Ryan needed a minimum down payment of $8,750 and likely another $7,500 or so to handle his closing costs, which meant he probably needed about $16,000 or so to cover his down payment and his closing costs. So honestly, you might be asking, what the heck are closing costs? Well, it's a very good question, and honestly, that's the most we're gonna cover here on this film. But we want to encourage you to go watch our film specifically about closing costs, where it's going to get into much more detail and hopefully get all those closing cost questions answered for you. So go watch this closing costs film. All right, so for assets to be used in an FHA mortgage transaction, they must be seasoned in an official bank account for at least 60 days. And we're gonna verify that seasoning by requesting the past 2 months of bank statements from any account that you're gonna be using to cover your down payment and your closing costs. So this means you can't use money that you've stored in your mattress or a coffee can or cash that you've saved up in your safe. Those funds are not gonna be seasoned and they won't be usable until they've been deposited into a bank account. So quick pro tip, if you're more than 60 days away from buying a house, then we've given you plenty of time to grab that mattress money, that coffee can money, that money from your safe and take it to a bank and get it deposited into an official bank account to start that 60-day seasoning process. Okay, so we just talked about seasoning. Let's talk about some things that don't require seasoning. So specifically is payment from your job, right? So if you get a direct deposit or a paycheck, that does not need to be seasoned because we can source exactly where it came from, right? So your pay stub will help us source that, right? And then you maybe have other verified income deposits, like maybe from your retirement account or from Social Security, those types of things. They're exempt from seasoning, which means they don't need to sit in your bank account for at least 60 days. So there's also other deposits that are gonna be exempt from seasoning, and those would be something like if you sold an asset or a car, right? So if you did sell a car, you could source that sale, right, on a document called a bill of sale. Or if you sold a house, you're gonna get a document from the title company, from your escrow officer called a settlement statement, right? Those effectively source the sale of that asset, and they don't require those funds to season for at least 60 days. So hopefully that makes sense. So maybe right in this moment, you're planning to go sell a car and you're gonna try to use those funds to help cover your down payment. Just be sure that you document that sale thoroughly through a bill of sale document. Hopefully that makes sense. All right, so maybe you're in the camp where you don't have anything saved up at all. And if that's you, then you are just like Ryan, which that's fine, right? Because the good news is Ryan was not out of luck, and hopefully you are not either. FHA allows for down payment assistance, and we used a local program to help Ryan cover his closing costs and his down payment. And in Ryan's case, this was a traditional second mortgage that had an additional monthly payment. So just a quick thought, right? When you go get down payment assistance, it usually comes with a cost. In Ryan's case, it was a traditional second mortgage and it had a monthly payment. The interest rate was probably fairly similar to the first mortgage. The term of that loan was certainly less, right? So most of the time you're gonna take a first mortgage out through FHA and it's gonna be a 30-year fixed. That second mortgage may be between 10 and 15 years, right? Yeah, so long story short, if you're like Ryan and you don't have any money saved up for a down payment, you are not out of luck. We've got access to lots of down payment assistance options depending on where you are in the country. We'd be happy to help use that down payment assistance to help open a door for you to buy a home. So additionally, maybe unlike Ryan, you might have a family member that wants to contribute to help cover your down payment or closing costs. That would be called a gift, right? And that gift would be documented through a gift letter that the donor and the recipient both sign, right? So that again would help us be exempt from seasoning, right? So if mom, dad, grandma, grandpa, brother, sister, a close relative wanted to give you a gift, that's absolutely allowed. All right, so jumping in here again with a really quick pro tip, just kind of zooming out for a quick second, or better yet, actually kind of zooming in, trying to talk to you personally here. If you ask a family member for a gift and they say yes, just make sure that it is actually a gift and not a loan, right? So any loan that you take on from a family member or any other source will have to be documented in your debt to income ratio, right? So we want this to be noted and disclosed as a gift, right? And then what you guys do post-closing, honestly, what I don't know isn't gonna hurt me, but certainly wanna document it as a gift for the sake of underwriting. All right, so we've had hopefully a really thorough conversation on both income and assets, and now it's time for the lender to assign you homework, is kind of what we call it in our world, right? So that means it's your time to go complete a loan application, or you can ask your lender for help with that to do it over the phone. But an application at this point needs to be completed. And then the lender is going to give you a specific list of documents that we need from you. So that's basically your income documents and your asset documents, right? So if you're employed by a company, we're typically gonna ask for 30 days of pay stubs and the last 2 years of W-2s. And assuming your money is in some sort of a bank account, we're gonna ask for the last 2 months of bank statements. So hopefully that all makes sense. Hey guys, it's Gavin here. Just wanted to take a quick second. If you're ready to take the next step on purchasing or refinancing, click the link below, fill out our form, and we'll get you connected to our pre-qualification team as soon as possible. All right, so we've talked income, assets. We've now talked a loan application and a list of documents. So the last thing we want to talk about here is your credit history. So technically, FHA will allow for a credit score for as low as 500, but you'll need to bring at least a 10% down payment in that case. And this is just me being super honest with you. It is super unlikely that you're gonna be approved with a 500 credit score. And to be honest, it's really unlikely you'll probably be approved with a credit score of less than 620. But let's back up for just a second. So technically speaking, to qualify for FHA with only a 3.5% down payment, you can have a credit score as low as 580. But again, like I said, really challenging to get qualified or approved for a loan, any loan with a credit score that low. So we always want to recommend at least a minimum credit score of 620. And ideally it's higher than that, right? So again, let me just zoom in here and talk to you personally. If you find yourself in a situation where your credit scores are low, we've seen credit scores in the 300s, so don't be embarrassed whatsoever. But we've got some great partners we'd love to get you in touch with, and they can help you put a plan in place that would allow you to be able to be a homeowner sooner than you might think. So let's talk more about credit repair. When you guys reach out to us, we'll have that conversation, but just want to invite you to scroll down, find our contact information, send us a note, talk to us about credit, and we'll be happy to get you connected to a great credit repair partner. All right, so let's jump back into Ryan's story. It's been a minute. We've kind of left him behind, but Ryan had a middle credit score of about 620, and that was good enough for him to qualify. So again, like I said, looking for a score of around 620 in order to get qualified for an FHA loan. All right, so we're gonna actually order a credit report, which will help us understand what your credit scores are. It's gonna show us scores from all 3 credit bureaus. You've probably heard of them: Experian, TransUnion, and Equifax. You'll have a different score for each. Those scores are usually pretty similar to each other. The other thing your credit report's gonna show us is a comprehensive list of your outstanding debts and liabilities, and each of those likely has a minimum monthly payment. So think of a car loan with a minimum monthly payment, think of a credit card that has a minimum monthly payment, maybe a student loan. Basically anything on your credit report we're going to look at, and then what we're gonna do is actually import those liabilities and those credit scores into your loan application. So hopefully that makes sense. One more thing about credit scores, you're gonna get a different score from each of those 3 bureaus. What we'll actually do is take the middle of those 3 scores, and that middle score becomes our decision-making score. All right, so one more quick pro tip here for you. So maybe you monitor your credit scores through Credit Karma or through an app from a credit card that you have. You're gonna see scores on a regular basis, right? They're always gonna give you an alert that says, hey, your credit score has changed to X or whatever, right? So when we pull your credit report on the mortgage side, we'll actually find likely lower credit scores than what you're seeing through those monitoring services, right? And that's very simply because a mortgage credit report is going to pull a different set of FICO scores than what you're being provided on those apps. So basically, long and short, it's typical we're gonna see lower scores, and that's okay. It should be expected. So hopefully that makes sense. All right, so now that we've received your loan application, your documents, and your credit report, it's now time for our team to shine and determine if you're pre-approved and what your buying power might be. And we're gonna do that largely through something called a debt to income ratio. So you do not need to understand how to calculate this, but I think it's helpful to understand it, to be totally honest, right? So no test or quiz, you don't have to be an expert at this. It's really our team's job. So at the time we recorded this video, a good rule of thumb is that FHA will typically allow for a debt to income ratio of up to about 50%. And that's gonna be plus or minus 2 or 3 percentage points, right? So somewhere maybe between 47 and 53 on a debt to income ratio. And you're like, what does that even mean? Well, to calculate your debt to income ratio, we're gonna divide your minimum monthly payments from your credit report. So remember that credit report we just talked about, that auto loan, that student loan, that minimum payment on your credit card. We're gonna add those up, and then we're gonna divide it by your qualifying monthly income. So if you're an employee, we're gonna use your gross income. And if you're self-employed, we're gonna use your net income. All right, so we've left Ryan in the dust. Let's bring him back here to the forefront. So Ryan's monthly gross qualifying income was $6,000 because Ryan was an employee of a company, not self-employed. So we use his gross income. So that means Ryan could have recurring minimum payments, including his new mortgage. So that's really important. We do take into account the new mortgage plus taxes, insurance, mortgage insurance, HOA dues, all those things. And in Ryan's case, a second mortgage as well. So, right, he could basically have recurring monthly payments of up to about $3,000, right? So if his income's $6,000, 50% of that's about $3,000. All right, so Ryan had minimum credit card payments, student loans, and an auto loan totaling of about $1,000 a month, which left him about $2,000 per month that he could put towards his new mortgage, right? So $3,000 less his recurring $1,000 leaves $2,000, pretty simple math, right? And again, at that time, a payment of $2,000 per month equated to a purchase price of roughly about $250,000. So if we rewind all the way back, that was Ryan's goal, was to be able to buy a house for $250,000. And magically, the numbers worked out for him. All right, so another quick pause here, pro tip, whatever you want to call it. Interest rates play a huge role in your buying power. So lower interest rates mean lower payments and therefore more buying power, while higher interest rates is going to mean a higher monthly payment and therefore less buying power, right? So our hope is that as interest rates go up, maybe home prices stabilize or come down. And then what's likely true on the reverse side is as interest rates come down, buyers are going to get more excited, the market will heat up, and there'll be more competition, which means home prices will likely appreciate faster. So hopefully that makes sense. All right, so before we wrap this up, it's super important to mention something that we haven't touched on at all quite yet. So FHA loans are awesome, but they are limited, right? So they are only for the purchase or refinance of a primary residence, which means you can't use an FHA loan to purchase an investment property or a vacation home. And the home must also meet minimum health and safety standards. So the appraiser is the one who's going to visit the property and they're going to note any major deficiencies, right? So cracked or peeling paint, huge cracks in pavement, missing handrails, maybe broken windows or missing shingles, basically anything that would negatively affect the health and safety of the property. The FHA appraiser, or more specifically just the appraiser that comes on site to complete the appraisal report, is going to note those things. And what's going to happen is they're going to have to be fixed before the home can close. And that's usually going to be at the expense of the seller. So just keep that in mind, right? All right, so back to Ryan. Ryan ended up buying his first home with an FHA loan and down payment assistance, and it worked out amazing for him. In just a few short years, his home appreciated in value fairly substantially, and his income and his credit both improved as well, such that we were actually able to refinance Ryan into a conventional mortgage with a lower interest rate, got rid of his mortgage insurance, and we were able to save his family about $300 a month. A really, really amazing story. So Ryan started with basically nothing but a dream to own a home. He really didn't have much of his own money at all. We used down payment assistance to help him get into the house. And now 5 years later, Ryan owns a home with a substantial equity position. So I got to ask you, who wants to be the next Ryan? All right, so hopefully Ryan's story was compelling enough that maybe your heartstrings are tugged a little bit, or maybe your dream is percolating as well. We would love to be a resource to you. Scroll down, find our information, fill out that job form. We'd love to have a conversation with you, hear some of your story, and help get you on the process towards homeownership. So if you're ready to get started, if you want to be the next Ryan, reach out. We would love to help guide you through the process. And if you're curious to learn about all things mortgage related, we suggest that you go watch this video next.